So we're going to walk through the formulas that you would need when dealing with multifamily investments. So this is the formula to value the property, right? So you have your property value, and then you have your NOI, which is your net operating income. Your net operating income is your income for the property minus your expenses. Then you'd have your cap rate. And your cap rate is basically the rate of return you would get if you paid all cash for the property. So if you have a higher cap rate, that means it's basically a higher risk asset. Whereas if you have a lower cap rate, you're going to buy a lower risk asset. And what do I mean by that? So like if I'm buying a property in New York City, the cap rates are going to be 3%, 4%, right? Whereas I'm buying a property in a really tough neighborhood, you're going to want more return on your money. You're going to want like a 10% return on your money to even consider investing there from a cash on cash standpoint. So your cap rate is going to be your rate of return. The higher the cap rate, the riskier the investment. The lower the cap rate, the less risk of that investment, right? So here. So the property value is equal to the net operating income divided by the cap rate. So this is digging in deeper into the net operating income. So you're going to have your income, which is like your rental income, parking expenses, if you're charging for pet fees, right? That's going to be all your income. And your expenses are going to be, repairs and maintenance. You're going to have maybe some water bills, some electric bills, right? You're going to have property management, right? So you have your income minus your expenses to get your net operating income. And you would find your net operating income on your T12. That's your trailing 12. Basically your profit and loss statement. But the multifamily real estate term is your T12, right? It's going to show you all of your income. Then it's going to show you all of your expenses. And then you subtract your expenses from your income to get your net operating income. The cap rate, right? So the cap rate is going to vary, right? Like depending on where you are in the country, where you are in a city, where you are in the investment cycle, right? So, for example, like in Washington D.C., where I'm at, specifically where I'm at, the cap rates are lower, right? Because it's a nicer neighborhood, right? But there's a couple neighborhoods here in D.C. where the cap rates are going to be higher, right? Because you're going to be taking more risk. You're going to be maybe renting to a riskier tenant that maybe has more potential for not paying their rent. So you want you want a higher return on that. So you'd want a higher cap rate for taking on that additional risk, right? So your cap rates are going to vary depending on where you're at, whether you're in Jacksonville, whether you're in New Orleans, whether you're in Texas, right? Your cap rates are going to vary. And your cap rate is dependent upon, like if the market has good jobs, good population growth, right? It's all based on supply and demand. If there's a lot of demand for real estate in that area, then your cap rates are going to be low. It means your values are going to be high. If there's not a lot of demand, your cap rates are going to be bigger, right? They're going to be higher, right? And then your values are going to be lower, right? But you're going to be cash flowing more, right?
A lot of people think just because it's a high cap rate means there's more opportunity and maybe it's a better deal, right? Because you're paying a lower price. Well, that's not always the case. You always got to look at each deal specific to that deal, do a full analysis, right? And make sure that cap rate is even sustainable, right? Make sure that, the bottom's not going to fall off of this thing in a couple months after you take it over, right? So automatically, just because it has a high cap rate doesn't mean it's a good deal.
Right. High cap rate to me as an experienced investor means higher risk. Low cap rates mean low risk to me, right? So Property valuations. We're going to go through an example here. We got property number 1. It generates a net operating income of $1.2 million. And you have a market cap rate for that area of 8%. So you take $1.2 million, you divide it by 0.08, which is the cap rate. You get a value of that property of $15 million. Now we take property number 2. It generates half the income at $600,000. You take a cap rate of 4%, which is half of the 8%, right? Previous for property number 1. You take $600,000 and you divide it by 4%, right? You get $15 million. So you see the power of the cap rate. This property is generating half the income, but the value is the same. So if you increase that income for this 4 cap deal, right? Your value is going to pop even more. Right? So this is in areas where your cap rate is low, it's going to be a low risk return investment, right? Whereas in areas where your cap rate is going to be higher, you're going to be taking on more risk. And that's why your cap rate is higher. So a change in the cap rate can make a big difference. You see that, right? Like half of the cap rate, half of the income generates $15 million. Where this one, it had to generate $1.2 million in income, an 8% cap rate, $15 million. So the cap rate is a big factor in creating value. Now with the federal government spending and printing $14 trillion in stimulus, right? That is creating a situation where interest rates are extremely low, which then creates cap rate compression. And as cap rates compress, you saw on the previous slide, values go through the roof. This is where legacies are made. Imagine taking that $1.2 million and dividing that by a cap rate of 4%, right? That's tremendous value that's created. So being able to calculate the value of the property is great, but being able to increase the value of the property is what this is all about. That's why we're here, is because anybody can calculate it, but increasing the value, buying these deals and increasing the value is really where the fun begins. That's where it starts, right? We have the cap rate valuation. It magnifies the impact of the NOI and the changes, right? Brian, do you have anything you want to add to this slide?
Yeah, guys. I mean, if you're paying attention, you'll notice we covered this this topic earlier in the course as well. But we're hitting it again because this is so important, guys. Right? This is it right here. If you wanna make money on this property, you have to increase the NOI. You have to understand how the impacts with the cap rate to increase the value of your property, right? This is it.
Totally agree. He's 100% right. You know, cap rates have a tremendous ability to magnify the value creation at that property. We got property number 1, right? It generates an NOI of $1.2 million. We have the market cap rate of 8%. So the $1.2 million divided by 8% is $15 million, right? Then we have property number 2. It generates an annual NOI of $2 million. That has a cap rate of 8%. $2 million divided by 0.08, right? $25 million. So you can see here where you increase that NOI, same cap rate, you just created $10 million in value. It's tremendous. And increasing the NOI is basically telling your tenants, doing some renovations in the apartment and being able to increase the rent on your tenants. Has anybody ever had a $20 rent increase? $50 increase?
Or
$100 rent increase. You do that on 100 units, right? $100 rent increase on 100 units is $100,000 a month. Multiply that by 12, that's 1.2 million bucks. You divide that by a cap rate. That's where you see this value creation, $10 million. What would that do for you and your family? We got your valuation calculations, right? We got expenses. If you're able to reduce a 6 cap property insurance costs by $15,000 a year by negotiating or calling other insurance providers and getting a new policy, right? $15,000 divided by a cap rate of 6%, you would create $250,000 in value. How many hours would you have to work at a job to create $250,000 in value? That's why most people are stuck working a job. And some people are investing in real estate, changing their life because they understand this powerful tool. You can create so much value with this by doing a little bit of work, calling your insurance agent and saying, hey, what can we get? Can we get a better rate? Can we do something with the insurance? Shopping the insurance numbers, right? You save $15,000 a year, you just created $250,000 in value. Here's an income situation, right? If you were able to raise your rents by $10 a month on a 200-unit 6 cap property, and $10 a month is a small rent increase. Have you ever had a $20 rent increase, a $50 rent increase, a $100 rent increase, right? Definitely, right? I used to get like $200 rent increases when I was living in New York City. You take that $10, right, and you multiply that by $200. For 12 months, that's $24,000 NOI that you just created by increasing your rent on the tenants by $10. By $10 a month, there's $24,000 NOI. You divide that by a cap rate of 6%, you just created $400,000 worth of value for you and your investors.